Hey, good morning, everyone. Marty Mazzora here. It's the 2nd of January, 2026. Happy New Year to you all. Hope you had the best holiday season. This morning, I'm going to focus on some long-term charts, and along the way, the monologue will inspire me to share with you, clients in particular, some of the changes that we're making to our core allocation. Speaking of the core allocation, yes, it was a very good year last year at clients, as you noticed, in that just on a straight up rate of return basis. Under the surface, the way we analyze things, it was a special year on a risk-adjusted basis, meaning the return that the portfolio was able to generate relative to the risk that we took while managing it was special. And I think we'll just leave it at that. No reason to celebrate or bask in last year's success because last year's over, and now we need to be painstakingly thinking about and managing our clients' money into what remains a very uncertain future, as you might imagine. And pardon my voice, by the way, it's feeling a little scratchy as I continue to talk here, so bear with me. And speaking of uncertainty, today it's just, again, first trading day of the year. Not sure what the volume looks like. Haven't looked at that just yet, but it is a Friday. It's still in that last stage of the typical Santa Claus rally, which is the first couple trading days in January. So Monday would be where the traditional, so to speak, Santa Claus rally stretch ends, and essentially we really didn't get it this year, interestingly. And in terms of just today's action, I mean, the S&P has been all over the place. It started nicely higher. As I speak, it is flat as a pancake, up 0.02%. It's been in the red. The NASDAQ 100 index is still in the red by 0.25%. The Dow is actually up 200 points, so it's up 0.4%. It was down earlier in the session. So, folks, lots of rotation going on, lots of trading going on still. It looks a lot like the latter part of last year. And to us, this feels very much, like late cycle dynamics. Gold, for example, is up 0.2%. It was up, I believe, a full 1% earlier in the day. Silver, and we'll look at that chart in a minute, is still up 1.5%. It was up 3% earlier. And platinum, you'll see why in a minute. I'm bringing up the metals. It's up 4%. As I talk at you today. Core portfolio, by the way, is up 62 basis points, so nearly 0.2%. So it's having an unusually good day relative to the overall stock market. But again, as I continue to preach, your clients, your portfolio is not remotely an all stock market portfolio, nor will it be as we make adjustments going forward, as we'll talk about a little bit here today. Okay, so let's jump at the charts. And again, I'm just going to focus on the long-term charts today because we are long-term investors. But as you know, on our weekly videos, we do get into the short-term dynamics of the market as well. But today, again, long-term. Here's the 30-year monthly chart of the S&P 500. And folks, we are very firmly in what we call a rising wedge pattern. You can see up here, right? And rising wedge patterns by themselves are not necessarily bearish, but when you combine them with bearish divergences, which we don't have on the moving average convergence divergence, by the way, but you could argue that we do on the relative strength index. As you can see, where we've had market sell-offs historically, they often come at the end of rising wedge patterns. So one thing, though, to point out here is that on the RSI, if you can see it becomes red shaded above 70 right in here, the relative strength index. What it does is it compares the current action to the average of the last 14 periods, and in this case, these would be months. So just notice historically for the last 30 years how overbought conditions tend to be resolved. There's a 20% decline. There's a 50% decline. There's nearly a 60% decline. All of these coming off of overbought periods. But notice, like here in the late 90s, you can stay overbought for an extended period of time like we did here. But more recently, right before the great financial crisis, overbought off and on for the course of about a year, and then that massive decline. Got overbought for a year and a half or so, 2015-16, and we had somewhat of a correction, all in about 16%. Got overbought here right before the 20% decline in 2018. Not quite overbought before COVID, which was 35 to 40% decline. Definitely got overbought before this 30% decline in 2022, before this 20% decline last year, and very much in overbought territory. So what does that say? Absolutely, we should be expecting some corrective action, I suspect, during the course of this year. As for the NASDAQ index, a little less busy. You can see I haven't drawn much on this chart other than the extent of the declines. But again, you got overbought right here before the tech bubble, which was an 80% decline for the NASDAQ, which obviously heavily loaded in tech. Got overbought right before the 54% decline in 2008. Got overbought for, a few months anyway, almost a year. Actually, it was just over a year before a 30% decline. Overbought for about a year before a 26% decline. Again, before a 38% decline. Briefly overbought before the 26% decline last year. And in overbought territory. So basically the same thing. So folks, what I'm saying is that the equity markets, these two major indexes that so many people pay attention to, have gotten out over their skis from a technical perspective. Now, these overbought conditions could be resolved by moving sideways. They aren't typically, but it is possible. So that's a possibility as well. But certainly we should be hedging a bit against something somewhat dramatic, something that you'd feel on the downside. Taking a look at gold, this is the spot gold price over the last 30 years, another 30-year monthly chart. I've shown you this before. And this is largely why we are hedging against anything more than about a 10% decline in our pretty large gold position, which has been really, really good to us of late. But you can see that gold has not been this overbought since right after Nixon took us off of the gold standard in the 70s. And you can see the resolution of that overbought position was a 45% decline. Got overbought here again in the late 70s to see a 57% decline. Briefly overbought here in the late 80s, 33% decline. Got overbought briefly here, call it a 9% decline, followed by another overbought period that resolved with a 26% decline. Here we got overbought, 42% decline. Here we got overbought, 17% decline. I suspect gold has something noticeably in terms of double-digit correction before this is over. I think that's how this will ultimately resolve. Now, granted, we remain actually structural bulls on gold. We think gold is going to be a good story for years to come. And we do recognize that a lot of this has come by way of central bank buying, which is unusual from a historical perspective. So some argue that that is the difference between all these overbought periods, and then they're not just going to wholesale sell gold and allow it to come crashing down. I appreciate that argument, and I like the fact, as a holder in gold, that there is that factor in there, possibly supporting the price. But there's also a lot of speculation in that price as well. Obviously, that knowledge of what central banks are doing are going to pull a lot of other speculative money into it. And any excuse for those profits to be taken, I think, will be taken. And we'll see a pretty good correction in gold. We just want to be in a position to stay long-term, continue to benefit long-term, but not, suffer the kind of decline that I think is likely to happen with gold. Now, the other precious metal, silver, has been utterly ridiculous in terms of the move. This is as parabolic as you're ever going to see a chart. And by the way, you're never going to see a chart that's this parabolic without something meaningful, to the downside. That we're up like 440%, and we haven't owned it that long. We did cut some this last year, and we're glad we kept a good chunk because it just continued to go up. And we are going to be managing that, make no mistake, as we enter this year as well. Another massive gainer has been platinum. We switched from palladium to platinum. I believe it was early last year. We did really, really well in palladium. We did even better in platinum. We have managed that position. We are going to be managing it some more, meaning taking some of that off as we get into 2026. So folks, these are things that, may be at breakouts. I mean, some of these bulls are saying, listen, this is now breaking out above, 2008 levels, right? This is now, silver breaking out above, these 2008 levels and so forth. And, I'm a believer, but I also believe that it's going to play out technically like most breakouts do. And as where you come back and retest the high. So as we manage our position and realize some of those profits, make no mistake, we're going to be looking at adding back somewhere, between here and there. I'm not saying we'll wait for 50, but I definitely would not be buying here at 72 and notice, the drop, 10% drop very swiftly right in there off of this massive, 1 month candle right here. And then, people are arguing the same for gold, right? Remember, I was drawing this range back in here, expecting gold to correct, right? And particularly as we got overbought up in here, I kept pointing to this. Yeah, we got a pretty good correction there. We've been getting a pretty good correction here lately. But indeed, we did break out aggressively to new all-time highs, right? Now, being bullish, this is the beauty of hedging. Being bullish long-term and not wanting to give up any of the position inspired us just to put on a cheap put option so that we could stay in that position, spend just a small fraction of what we have in gold just to ensure it, just in case we get one of those 30-40% declines, we get to preserve the lion's share of our gains for a very cheap cost, and that would be the put option premium. In part one of the year-end letter, I explained at the end kind of the concept of hedging, and that is that essentially the message is that in a perfect world, you spend money and you burn premium and you actually have a cost. It's like buying insurance. But what that cost does is it allows you to stay with your long-term thesis, your long-term structural beliefs at times when the market pushes them too far, too fast, right? Without having to try to guess, is this the top? Should I sell? Should I try to rebuy? No, not in our world. In our world, it's, this is a time to hedge. And stocks have been that way for a very long time. And we've been hedging consistently now for the last 5 or 6 years. But it's allowed us to stay in a market that looks pricey like it did in the late 90s. But if you got out too soon, you paid for it. The secret is to be hedged along the way. And that's something we're going to continue to do in a very dynamic fashion going forward. Okay, the dollar. This is a 5-year daily chart of the dollar, just to kind of show you here. One of the reasons that we did so well this last year is because we had a bearish thesis on the dollar. And sure enough, the dollar took quite the hit last year, right? Down about 10%. And longer term, we are bearish the dollar, and we think that's going to play very well for the way we're allocating assets currently. That said, we will get periods of dollar strength. And as I pointed out in here, we were calling for a dollar rally right off of this level, and that's exactly what we got. And we were pleased that it really didn't hurt us that much, being in a very diversified portfolio, despite the fact that we're pretty short the dollar. We still made money during that period. But the dollar is going to be key, and if you can get the dollar right going forward, then we're going to get a lot of other things right as well. The yield on the 10-year, as you can see, we're pushing right back to the highs that we saw back here in late September and then again in December. So we've been bouncing off of this. Real diverging schools of thought here. If you're in the recession camp, you should be buying the 10-year and expecting the yield to go down. That'll push your price up. If you're in the expansion/inflation camp, you're going to see yields go higher during the course of this year. And I would say these camps are dividedly split with very, very smart people in each. And I talked a little bit about that in one or two of the year-end letters as well. So our view is that there is going to be a not small amount of fiscal oomph hitting this market early in the year. We're looking at what are likely record tax refunds that the consumers are going to receive this spring, and they tend to spend that money. We are looking at essentially the acceleration of what the Big Beautiful Bill Act is ultimately going to do for the economy. The Federal Reserve did cut interest rates in December, and notice that for the month of December, long-term interest rates actually went up, and that's the risk of cutting into a market or an economy that's not ready to roll over into recession. And as I'm sure you know, Chairman Powell is going to surrender his position here in 3 or 4 months, and he will be replaced by a presidential appointee who commits to being very dovish with interest rate policy. Right now, keep in mind the chairman or the chairwoman in and of themselves do not get to decide what policy rates are going to be. It is by committee, although they are very influential in that committee. And as more folks leave the committee and more are appointed by the current administration, there's going to be a lot of political pressure to keep interest rates somewhat at bay, particularly when you look at the government borrowing massively on the short end of the curve. That Fed funds rate is going to have its biggest impact on short-term T-bills, which is where the government is going to be funding its deficit. In a world, though, where there's a lot of fiscal spending, a lot of other stimulus coming into the economy, it will likely push longer rates, and that includes mortgage rates, higher during the year. So that's a real risk. As I mentioned in the written blog, that's a huge caveat to any bullishness that you would have, and perhaps that would come to the fore in the second half of the year, in that if indeed inflation starts to ramp back up and interest rates begin to rise, that's problematic for the market. That was pretty much the catalyst that forced nearly a 30% correction in 2022. So we need to be aware of that and positioned for it as well. So in terms of positioning and themes going into 2026, just without giving you any ticker, let me just kind of touch base on what we're doing. So I mentioned that we're going to be managing these metals positions that have gotten way out over their skis. And what I mean by that is cutting some of that exposure. Some of the things that we're adding have to do with this massive AI spending that's only predicted to ramp up this year. For example, in that area, we are adding data center real estate investment trusts. So we want to essentially capture some of the positive of all that spending that probably hasn't been entirely captured, like, say, the stock of NVIDIA at this point. Some of the areas that are huge beneficiaries, but have somewhat gone less noticed or even unnoticed by the market. These data centers, the pressure that they put on the utility space is enormous, if not exponential. That's a problem. And that would be electricity that these things demand. So there is going to be, and part of the Big Beautiful Bill Act focuses on this, there's going to have to be very targeted investment in grid modernization, the capacity of the grid, and so forth. So we're investing in an ETF that really focuses on those stocks that capture that investment. Same thing with renewable energy. We're going to need a combination of everything in this real energy intensive world that we're facing right here. We're adding a small starter position in a computer chip company that benefits from the AI spend that hasn't been getting the love that NVIDIA has been getting so far. We're going to maintain positions in a couple of biotech stocks that we've made a position in. We've done very well in a retail shoe company that was left for dead. We're going to maintain that position. It's doing very well today as well. And then other areas of the world, we did add a Chilean miner this last year, partly because it had been left at it and what our expectations were for the Chilean election. That turned out to be exactly what we expected. And consequently, we had quite the run in that stock, believe it or not, up 82% since we added it. We think that investing in the Chilean market in a broader fashion will make some sense, so we're adding a small position there. I don't feel like we're chasing. I think this could be a structural positive story going forward for a while. We do have exposure to Japanese equities in our developed Asia ETF that was up over 20% this year. We do think there's reasons to be bullish from a number of perspectives on Japanese equities, so we're adding some direct exposure there as well. Last year was much better for non-U.S. equities versus U.S. equities. That, to no small extent, along with the commodities, explains how well we did last year. In part one of my year-end letter, I showed you that the valuations internationally versus the U.S. are still very compelling in favor of international stocks. And I do believe, particularly if we're right on the dollar, that we could be at the beginning, at the early stages of a longer-term trend there. So by no means are we abandoning the U.S., but yes, we're continuing to look outside of the U.S. for opportunities that provide better-looking value than these extremely high-priced U.S. tech stocks, for example. So folks, again, if I had to just kind of sum it up, and I think I will, I'll read from our internal memo. This just comes from our executive overview. It's constructed to align with the prevailing macroeconomic setup entering 2026, again, characterized by sustained fiscal expansion, structurally softer U.S. dollar, stable but elevated inflation, and on the margin improvement in global manufacturing activity and shifting geopolitical and supply chain dynamics. The portfolio emphasizes real economy exposures, broad-based global equity diversification, and a deliberate mix of inflation-resilient assets while retaining the flexibility to strategically hedge specific positions or asset classes as conditions warrant. As you can gather, I'm not using the R word all that much, right? Despite the fact that, as I showed in the written blog, a number of our indicators are screaming recession risk. As I keep saying, though, I just have a tough time worrying about recession when the federal government is spending something like 5 or 6% of GDP in terms of its deficit. Typically that kind of spending is reserved for deep recessions and trying to spend their way out of it. And here we are. And so, again, I just think it's tough to see any type of a protracted recession in that scenario, but I do think inflation is a risk. The PWA index, I just scored it a couple days ago, and it is now completely neutral from slightly negative. So even our own general conditions index is just basically right on the center line between recession risk and continued expansion. So while people who we respect greatly, like the analysts at BCA, see high odds of recession this next year, contrast that with the folks at MRB who see virtually no risk or very low risk of recession this next year. I will say this, both are cautious on the prospects for U.S. equities. One, worried about inflationary pressures and the effect of rising interest rates on equities. The other, worried about recession and the declining profit risk for U.S. equities going into next year. So to sum it all up, we have to stay exceedingly diversified and dynamically hedging in both directions. And if you didn't get a chance, at the end of part one, I kind of get into the weeds a bit on hedging as well. So read that if you're interested. So folks, let me just do a hard stop right there. Went quite a while on that one. I appreciate you lasting to the end, those of you who did. And it's a new year. It's going to be very interesting and looking forward to it and looking forward to communicating frequently with you along the way. Have a great day. Take care. Bye-bye.